I want to talk to you about balance transfer ideas, and most importantly, I want to give you a few scenarios where a balance transfer could actually be a bad idea to you. I mean, people talk about balance transfer here, balance transfer there. It's a great idea. It's an excellent idea, of course. By and large, a balance transfer could be a great idea for debt consolidation. Could be a great idea for actually purchasing, like having a big ticket purchase. But you got to be really smart. Okay, so let me first give you some of the key takeaways here. Balance transfer credit cards allow you to expedite debt repayment because they provide a 0% intro APR period. Sometimes it could be over 12 months, over 18 months. You even have a balance transfer period over 24 months. So basically, the whole idea here is what? You want to reduce interest expenses for a time, right? But the thing is, if you can't repay your debt in the promotional period, or nearing the finish line on total debt repayment, or let's say are planning on applying for major financing soon, a balance transfer may not be a good move. And I'll explain to you why. Because there are actually some repercussions on your FICO score that could be really detrimental in the long run. And that's something that you definitely do not want to have. It's also not great for you if you have bad credit, if you feel overwhelmed by your debt, or you will be tempted to keep spending because you are getting a new credit card, right? So what you want to do here is you want to look closely at the fine print on a balance transfer credit card so that you fully understand terms and conditions, interest rates also. I mean, whatever you've been offered, you gotta have a clear idea before you decide anything. Before you sign on the proverbial dotted line, you gotta have a clear idea what you're really getting yourself into. Okay, so a balance transfer credit card can come in handy. Let's say when you want to pay less interest on the debt you owe on an existing credit card, or even on an existing loan, right? So this maneuver can save you money and buy you a little extra time to repay your debts, but not everyone is a good candidate for a balance transfer. Okay, so you got to be clear about where you find yourself and whether or not it's the right move for you. Okay, so but if you were to really understand balance transfer credit cards, you just want to look at the main feature. The main feature being you have an intro APR that goes from 12 to 21 months, and like I said, there are some credit cards that allow you to have even up to 24 months. That's 2 years. That's really good. 2 years without paying interest. That's fantastic. So let me share with you the top 6 scenarios where balance transfer move could be a bad idea for you. The first scenario is if you can't make your debt payments on time. Let's say you have a debt of $10,000, right? And basically you're not disciplined enough, or stuff happens, life happens, and you find yourself in a situation where you can't make your payments on time. So what happens here is that if punctuality is not your forte, a balance transfer might make things worse. I'm not saying that basically this is your fault, but it's just that stuff happens, right? But if for any reason you can't make payments on time, you do not want to have this situation, because on top of a balance transfer credit card's standard late fee, making just one late payment, or let's say missing a payment altogether, could actually forfeit your introductory 0% APR, okay? Actually negating the purpose of the transfer. You might also be subject to a penalty APR. I mean, some banks or credit unions might waive the penalty APR, but this is something that they actually analyze on a case-by-case basis. So I just want to say that there is a possibility for you to actually be subject, okay, to that penalty APR. And the penalty APR is actually higher than the card's standard APR and can go as high as 29.99%. So if they're giving you an APR of 18%, like the standard purchase APR of 18%, once you veer into the, how do I say it, into the penalty APR, you're looking at 30% APR. Okay, so instead of risking additional financial anxiety, you want to try some of the following actions first. First of all, you want to devise an on-time payment plan with your current credit card. So you want to have a clear idea about your budget, where you are at financially speaking, and see if you can devise an on-time payment plan. You want to set up automatic payments through your bank or a financial institution or directly from your paycheck. That way, you are pretty sure that you are covered, right? So that's actually what you want to focus on. And you also want to make more frequent but smaller payments that may be more manageable to you. Okay. So, for instance, instead of paying $100 every month, break it up into 4 payments of $25 every week. Okay. That way you're still in control. So another scenario, another time when a balance transfer is a bad idea is if your debt can be repaid relatively soon. Think about it. I mean, you can pay your debt within 12 months and you're getting a balance transfer for 12 months. It doesn't make sense because you'll still be paying the 3% balance transfer fee, right? So you got to really look at those things from a numbers point of view. So if you have the means, let's say, to pay off your credit card debt fairly quickly, say within 3 or 6 months, a balance transfer might not be worth it. Balance transfers are usually historically, they're really good when they were spread over a long time. Like the 21 months that I just told you a little earlier about 21 months, 24 months. That's pretty interesting. Things become interesting. But if you're looking at 3 months, 6 months, you can't really look at this transaction as economically advantageous to you. So most transfers take at least 1 billing cycle to go through, and you will likely be paying 3% and 5% of your balance transfer for the transaction, right? And remember that basically 3 to 5%, this is a one-time fee. This is not spread over 1 year. This is a one-time fee. So take the time to calculate how much you would save on interest for the remaining payments with the balance transfer versus what you would pay for the transfer fee, right? Then determine if the transaction is still a good idea for you based on the economics, based on the numbers. If not, a better tactic could be sticking with your existing card and making larger payments on your debt or extra payments every single month. Another scenario where a balance transfer is a bad idea is if you are tempted to overspend. I mean, if you are inclined to spend more and overdo it on your credit card, a balance transfer may only enable that behavior. Think about it. Because for balance transfers to be effective, you must stop adding new debt to all accounts. So when you transfer balances from one card to another, but continue to charge on that card, or other cards for that matter, you're just digging yourself into a deeper debt hole, if you think about it, right? If you think about it. So a better solution is to get your spending under control and set or follow a realistic budget that responsibly attracts funds coming in and out. So what you want to do is you want to have more control over your cash inflows and cash outflows. That way, you know whether or not you are actually you are breaking even, or actually coming out with an excess or with a deficit. So work on avoiding impulse spending and trying to pay more than the minimum due on your credit cards every single month. Another scenario where a balance transfer could be a bad idea to you is if you have less than desirable credit. So let's say you have poor credit. Let me just put it bluntly. You have poor credit. Okay, you have a FICO score below 579. That's actually considered, I would say, less than stellar credit. So you are in prime territory. So if you have less than desirable credit, things can be a little complicated. Okay, so keep in mind that you are likely going to need good to excellent credit to be eligible for a balance transfer credit card with a 0% introductory interest rate, because banks and credit union are actually reserving that privilege, because it is a privilege. Think about it. The 0% intro APR for 12 months to 18 months or 21 months or even 24 months is actually a privilege, okay, that the bank actually is reserving for their most their best customers. Okay, now if your credit isn't ideal, you may still qualify for the balance transfer, but not the 0% intro APR offer that's advertised. While there are some options for balance transfer cards for bad credit, the best offers will likely be out of reach, especially if you are trying to get things done on a, I would say, if you want to optimize things, okay? And even further, what I want you to remember here is that every time you apply for a new credit account, there will be a hard pull on your credit, right? So your credit score will ding for 5 to 10 points, okay, whether you are approved for the balance transfer card or not. So that means that you are losing 5 points or 10 points every single time your credit is accessed. Is that really what you want? So be sure you are 100% clear on what your interest rate and terms will be. In some cases, it may actually make more sense to stick with your original credit card until you can bring your credit score up by making, say, on-time payments and reducing your debts. That way, you are in control. Okay. And also on the alternative side, you can contact your creditors to see if they offer a temporary hardship plan, because this type of plan may waive any fees and decrease your interest rates for at least a few months, allowing more of your payments to go toward the principal and helping to reduce your overall debt. So this is kind of cool from a flexibility point of view. Another instance where you basically you like a balance transfer can be a bad idea is if you plan to apply for other major financing soon. Because see, if you're buying a house or you are trying to get a loan for a car, like a car, you want to get a car loan, or you want to buy some kind of equipment. Anytime you have a major credit program actually coming soon into your life, if you do a balance transfer, that's a bad idea, because it's going to, like a balance transfer is going to really it's going to position you as too much of a credit risk. Okay, banks do not want to really to lend to I would say a consumer that has concentrated risk into one product. Okay, so if you're preparing to apply for a mortgage or auto, home equity, or personal loan sometime soon, pursuing a balance transfer credit card could hurt your chances of getting approved for financing. And so that's something to really think about. And that's not just because of the credit concentration that I just mentioned a little earlier. It's also because a balance transfer credit card could temporarily lower your credit score, affecting your ability to get approved for a loan or even qualify for a low interest rate on that financing. Okay, so something to really think about. So what happens here is that you can actually be better off just by timing your initiative. So simply delay applying for a balance transfer credit card until after securing the loan that you want. That way you are in control. That way you know whether this works for you or not, and you know whether you can actually pay it. Okay. Also, another time when a balance transfer is a bad idea is if your debt is out of control. So this is kind of similar to what I said a little earlier when I said you are tempted to spend, to overspend, not just spend, overspend. Okay. So if your debt is out of control, then we have a problem. And this is not just a balance transfer problem. This is more of a financial problem. This is more of a budgetary problem. Okay. So if you feel overwhelmed with the debt that has become unmanageable, pursuing a balance transfer card may only put a temporary band-aid on the festering problem, right? So what you want to do is you want to go to the root cause of debt that's actually just growing like crazy, right? So while it may provide some short-term relief and savings, the low promotional rate, like the 0% or the 1% or the 2%, the promotional rate on your new credit card will eventually expire. It might actually expire within 12 months or 15 months or 18 months or 21 months, whatever. So if you haven't paid off the balance transfer by the time it does, you'll be back to paying higher interest rates. So this is something to really consider. So depending on your debt load, you may also only be permitted to move a portion of your credit card balance to the new card, actually. Okay. So it's what I'm trying to say here is that don't think that because you're trying to do a balance transfer, you are going to transfer your whole balance. No, you can transfer the whole amount or just a partially actually. So if you feel like you're sinking in a deep debt pool, explore nonprofit credit counseling, which can better address your long-term debt. A certified counselor can review your earnings, expenses, and debts and offer worthy solutions for getting out of debt. Okay, so that's something that you might want to think about. And in many cases, the good thing is you can think about a DMP. So DMP stands for Debt Management Plan. So this can be the recommended solution. So credit counseling agencies manage those plans for their clients, and debt management plans offer many of the same benefits as the debt consolidation, including lower interest rates and the convenience of a single monthly payments. And the good news is that there is no minimum credit score required to qualify, so that's really good. And thanks to lower interest rates, clients can actually pay off their debts in full much more quickly than they could on their own. So that's an important element. Now, one thing I need to say is that many credit counseling agencies and debt management plans are scams. So make sure you have found a legitimate organization before becoming a client. And if you want to know, please let me know in the comment section, and I'll certainly tell you whether or not the agency you want to work with is a scam or is legit. So those are the top six times a balance transfer is a bad idea. Okay. But it's important to understand that there is something else you need to consider before a balance transfer. So know what you're getting yourself into, okay, before you do a balance transfer or even transferring a balance in general. So you want to crunch the numbers. That's what I said a little earlier. It all boils down to the numbers. It's like it's pure math. Okay, it's arithmetic actually. Crunch the numbers to evaluate if this strategy will truly save you dollars over the long term. And don't forget to factor in any fees involved, right? The 3 to 5% that they're charging you right away. Again, those 3 to 5%, when you annualize them, basically you're really paying a lot of cash. This is not because those 3 to 5% fees are a one-time payment. They're not really spread over several months. No, those are one-time payments. Okay, so understand the terms of the balance transfer before signing over the debt. Make sure you comprehend what the introductory interest rate is, how long the promotional period lasts, what the interest rate will default to once that period is over, and how that compares to your current interest rates, right? You got to really be careful here. So perhaps most importantly, you need to have a game plan for repayment before you even have the new card in your hands. That way, you're pretty clear about your strategy for reducing the debt, okay? So whether or not a balance transfer is worth it depends actually on your financial situation. Because the bottom line is, even if you qualify for a new balance transfer credit card, it might not be the right financial tool for you, especially if you fall into one of those six categories that I just mentioned to you. Because the bottom line is that you do not want to fall back into the same trap you are trying to get yourself out of, okay? Because if you're not careful, you could find yourself making mistakes with your balance transfers that only push you further into debt. And we do not want to have that. We do want to have that situation. Plus, you will still need to use your new card responsibly after your transfer goals are met. So a balance transfer might not be worth it if you can't or don't want to manage another credit card. So balance transfers overall, and that's the bottom line, only work as a money saving strategy if you are willing to change any bad spending habits, right? Because everything starts with the spending patterns that you have, the habits that you have. So in addition to research, sorry about that. In addition to researching balance transfer credit cards, consider alternatives like debt consolidation loans and credit counseling. Because at the bottom line is a good credit counselor from a licensed nonprofit organization can help you create a repayment plan and reevaluate your spending. And again, if you have any question on that and you have any concern on that, let me know in the comment section and I'll certainly let you know whether you're making the right choice or not. So, as an epilogue into this conversation, I spoke to you about 6 times that balance transfer is a bad idea. I give you the key takeaways, understanding balance transfer credit cards, and those top 6 ideas. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.